Hello again, ladies and gentlemen. Well, thank you. Whenever you interview someone, you always say it's a delight to have them on stage. And for once, I'm going to be telling the truth, because the guest I have, Hugh Hendry, is somebody I've known for about 15 years, and he's a very interesting and entertaining guy. And there's two important things you should know about him. First of all, he's Scottish. Now, I come to America quite a lot. My wife's American, and people keep saying, how are things in England? But it's Britain. We have England. We have Scotland, which has many great philosophers, economists, and he will represent the Scottish point of view, and I'm very glad to hear it. And secondly, he is a deeply original and interesting thinker about history, which is my key subject. And so he's going to set current economic events in the light of hundreds of years of history and looking forward as well. So please welcome to the stage the founder of Eclectica Asset Management, Hugh Hendry. So Hugh, let's go back to when we did in first talk about your philosophy back sort of 10, 11 years ago. When your view, and you were OD Asset Management back then, was that the boom was to come in real assets at that moment. What was your thinking then?
I guess I have a history of contentious posturing, of developing a contentious narrative. And back then, I guess we were very focused on, as you say, history, its cycles. And that from the mid-1970s, if we start at the base point of 100, the stock market had gone up to 900. And commodities such as, if we take agricultural commodities, like corn, they were trading at 10. So one went to 900 and one went to 10. And kind of, who cares? One was a winner, one was a loser. And maybe that's what life's all about. But the intervention of the stock market crash, the TMT crash, between 2000 and 2003, meant that the relative price trends began to change. So with the real economy, it had stopped going down, and then on a relative basis, it had begun to outperform merely by doing nothing, merely by being an oasis in a world which at that point had been brought down by the craze and hysteria for technology. And so that, again, if you will, I always, I've said to you previously, I'm like a paranoid schizophrenic. I hear these voices in my head. And those voices are, they're voices that leap from the pages of historical accounts of how previous societies dealt with events that trouble us today. Those voices are actually looking like a doctor, looking at the charts of how a group of speculators are thinking of the world. And so that was coming together and presenting us with the insight that not only did we have a mean reversion extreme point, but we were beginning to see momentum come and favor the notion of rejecting the status quo. Again, if I'm to band around titles, I'm an existentialist. I'm here to tell you that God is dead. I'm sorry about that, but he's dead.
You haven't told the Republicans yet.
They're waiting till after the election. That there are no rules and that we're on our own. So I and my team have always tried to position ourselves outside the accepted belief system. Yeah? So as a CIO, I don't sit there in the morning with a call from a buddy at an investment bank saying, hey, Hugh, we've got this ace analyst and he says you should do this in currency or in rates. You should be buying or selling this stock. I mean, my communication is I don't want your first call, I don't want your last call, in fact, I don't want you to call. So we generate our own ideas, but it requires the legitimacy of trends. So for all of those reasons, 10, 12 years ago, I became a gold bug, if you will. I launched my hedge fund in 2002, at the very end of 2002. And in 2003, we made 50%. And by and large, that was from gold beginning to gain some momentum. And we ran that sort of strategy, gold and buying old economy, buying steel. I was saying to you earlier, we were buying strange German copper refiners based in cities. Imagine having a refining plant based in the middle of downtown Dusseldorf. and the chief executive would have handlebar mustaches, and you'd have very entertaining breakfast meetings. It was a different time, but we wanted to buy these crazy businesses because they would make sense in a world where China came to the fore and the tremendous surplus of capacity utilization was addressed, and these businesses would become super profitable.
And then around 2006, I think, people who are gold bugs often stay gold bugs, till their death, with their hold up with their guns and in Idaho or wherever. But you changed again and became a treasury bond bug.
Yeah,
so what explains that?
So that journey was, again, a new contentious conjecture, which was that gold couldn't reach absurd levels. As Citigroup and, well, not to name names, but as major investment banks came through and started to endorse very high price targets on gold, I began to realize that you required the intervention of paradox, that the Rubicon had to be crossed by central bankers. Central bankers receive a lot of pejorative terms from hedge fund guys and other members of the financial community, and especially the Fed chairman today and the contentious policy of quantitative easing. But my point was that these are very, very astute, very, very intelligent, and very dedicated citizens, and they're very, very aware of the past. And social democracies in the last 100 years, notably in Germany and in Latin America, have been befallen by hyperinflation crises. And so, knowing that, none of these policymakers would want to go down in history as the architect of Weimar II. So in order to generate the extremes of monetary policy, that the gold price of, say, 3,000 or 4,000 or 5,000, to generate that, something profoundly bad would have to happen. And so I reasoned, beginning in 2006, that were you to believe in an inflationary or hyperinflationary future, then the paradox was that you had to invest in 30-year US Treasuries. Try telling that to a crowd of investors. Think inflation, buy bonds, buy long-dated bonds. But the argument was, and as we saw in 2008, you required the intervention of the Lehman shock, when the world, for a moment, stood still, in order to take Federal Reserve rates down to zero. You required that in order to generate $3 trillion of money printing. So that kind of came through, and I made 50% in October 2008. Paul Tudor Jones did it in 1987. He was heralded as a genius, and I was heralded as a kind of crazy guy, but that's the way life goes.
I suppose we should emphasize you don't make 50% every month. It's those are the highlights.
Yeah.
Now, what's your view? What's your view now? So I know that you have, as always, strong opinions. So it's the creditor nations you're worried about, right?
Yeah, the creditor nations are the most leveraged. So when things are going well, my goodness, they go very well for the creditor nations. And the creditor system is you are exporting surplus savings and you're importing other people's income. And it's been, to my mind, that notion of mercantilism as practiced in Asia, I think we're at a point where we're in the death spiral of mercantilism. The most successful form of economic management in the last 100 years, I think, is shuddering and is being provoked by the challenge which lies at the very heart of it. Its Achilles heel, if you will, is that to pursue mercantilism, the creditor nations in Asia are having to short their own currencies. This is why China has $3 trillion of trade.
Absolutely. But I think to walk the audience through how that works.
So again, the system is, their claim to fame, if you will, in trying to steal a march. I don't use the word steal in a pejorative term, but to gain traction in world markets, they're clearly helped by being cheap, by being a cheap place, cheap labor, cheap currency. And the economics wants to restore balance, as we all know in this room, and it wants to reprice. And mercantilism uses the process of foreign exchange intervention to prevent the repricing of the foreign exchange function. And that creates the short. So China has $3 trillion. The private sector in Japan has net wealth denominated in non-yen assets of 55% of GDP. So there's another $3 trillion. And my fear is that at the end you get a short squeeze. And I think we're perhaps living through that experience in the context of Tokyo today in terms of the great and persistent strength of the Japanese yen. And it's very much cut against the grain of my community, the community of global macro managers. My community always wants to short JGBs, it always wants to short the yen, and yet they've gone in the opposite direction. And to my mind, it's this short position at the sovereign level.
So you were saying earlier the yen could go to 50, 60 to the dollar, and then what happens to Japan in that circumstance?
Right. So again, I'm saying that Lehman was a profound shock, and it brought forward zero Japanese rates in the West, and it brought forward money printing. But as a society today, we have greater knowledge than any other society that preceded us in the sense that we can now challenge the Friedman notion that inflation is a monetary phenomenon. We can challenge it with the notion that it requires a caveat, that $3 trillion hasn't done it. There is a $1 trillion figure that probably will do it. It's just not 3 trillion. So society is just saying that we need the most profound Lehman times X in order, if you will, to allow the central banks to cross my Rubicon, to be revolutionary in a manner that we can't dare them to be today. And that they can only be revolutionary when they've given up hope. So again, back to Japan. I go to Japan. I go there on a regular basis. It's a wonderful place. It's hard to believe that equities and properties have fallen by 80% over the last 20 years. It feels richer than any society I go to. Again, my world is full of paradox. So what I'm saying is the yen has to go higher and higher and higher such that when I touch down in Tokyo, there is pandemonium. And we're getting close to that point now because Japanese companies are on the verge. The impossible is happening today in Japan. Some of the largest Japanese corporates are on the verge of bankruptcy. Sharp would be an example of that. And I'm saying if we moved very rapidly into an environment of the 60s or God forbid, the high 50s, then you would see revolution, that Japan would be bust at that point, and you would see the disbandment of the Bank of Japan, and you would see the Swiss-like targeting of, say, 100, 110 on the yen. But the paradox is something profoundly bad has to intervene before that happens. And so if you go in and you want to be short JGBs for the ultimate response, you don't survive the journey.
And you also feel that the Chinese have got it wrong.
I do. I think that the Chinese, well, where do I begin? The
2008, when they did the stimulus.
But China's was like, to my mind, was like everything that was wrong with the star stocks on Wall Street in the last 10 years and the focusing of quarterly earnings. You had to beat the number. You had to beat the number. And you become corrupted by the process of having to beat the number. China is just this big mousetrap that was formulated to grow at 10%. And to heck with the consequences, if you will. And so they ended up accepting a system whereby you could have negative marginal rates of return on investment as long as the building of that office property or that additional airport that no aircraft lands or that city where no one lives, as long as that assisted you in hitting the target of 10% GDP growth. So that's been an issue with China. Secondly, in March 2009, they stood, the G20 stood in a line, and it was like a scene from a Hollywood blockbuster. They were going to save the world. And we broke the analog with the 1920s in that China playing the role of America. Unlike America, which retrenched, China said, you guys just have this, you're just capitalists. It's just such a poor system versus our planned economy. You're having a garden variety recession. You have these recessions on a repeated basis, and a recession will be followed by a recovery. So to help pave the way, we as China, with this formidable economy, we will build a bridge. We will build a bridge that will take us from March 2009 2 or 3 years into the future. We will be the engine, the locomotive that pulls the world forward. And by the end of that process, we may be flagging. And we may have incurred some inflationary pressures. But actually, that's not such a bad thing, because it might, if we've got a degree of inflation, it might take away this incessant pressure for our currency to rise. Maybe our currency will be weaker. And in 3 years' time, you guys will definitely have a sustained economic recovery. So we may be flagging, but we'll pass the baton to you, and with our export prowess, we will again take over the world. And I think that is being challenged by the absence of a sustained recovery. I know there's some green shoots in America. Certainly America seems, relative to the rest of the world, gaining a degree of solidity. But then we have the theater of the absurd, which is Europe and elsewhere. So I think that bet that the Chinese made in March 2009 could come unstuck, that they are now they've always been an operationally leveraged economy like Germany. But unlike Germany, they have now adopted financial leverage, the sovereign financing of these unproductive investments. So they now have double jeopardy, if you will. And if we don't have a sustained world economic recovery, then I'm very fearful of the events that could befall the Chinese. And don't tell me that they'll sell their US treasuries. It's not an asset. An asset is something that you can sell to protect yourself. If they sell treasuries, the renminbi goes higher and higher and higher. And there are little companies that export go bust. Yeah, so this perceived medicine is actually the poison that would just accentuate further. So we have a roadmap, if you remember, from the 1920s. My country, the UK, played the role of the hegemon of the US, the modern US, if you will, and the US played the role of China, challenging and seeking to usurp the hegemon. But with the leverage of the creditor cycle, the leverage of mercantilism, what happened? UK GDP, peak to trough, fell 8%. Peak to, 1 year in America in 1931, in real terms, it fell 23%. That's the leverage. Now, am I sitting here with video cameras saying the Chinese economy is going to contract 23%? Of course I'm not. But if we have a coffee later, I might say something different.
Now, we've just got time for a question or so, if anybody wants to raise their hands. No? In which case, anybody? No, no. All right, I'm going to ask you a question. So somebody was cabbaging, as we call it in Britain.
He's up now.
Oh, there we go.
We got him.
Do you think China can shift to a demand-driven economy?
Can it shift from a demand-driven economy
to a demand-driven? Domestic, yeah.
Yes, but that is no easy solution. Japan has changed its balance from an over-reliance upon investment to consumption. But that has been generated by 20 years of zero real GDP growth. That's the mechanism for it. You know, the difficulty you have is that the sovereign has to pay. It has to pay. It has no cash flow from a lot of these insane projects, and it has debt. You know, so it can, but through duress.
We're about out of time, but I want all these people here wanting to know. Oh, there's a gentleman at the back. Can you make it a short question, sir, and we'll have a short answer? Can you get him? Can we hear him?
Hugh, just curious, your updated views on gold. You mentioned your 2006 view, but where are you today?
So today I own gold. I wouldn't own gold on its own. I own gold and I'm short the S&P. And that's, let me tell you my thinking. That's a little bit, I'll be very brief. That was a wonderful trade for 5 years leading to the end of 2008. It's been a profitable but less predictable trade since the intervention of quantitative easing in March 2009. So there is an argument from market observations that quantitative easing has fortified the S&P versus the performance of gold. But that also may just be that from the beginning of 2009, gold was so fantastically ahead of itself versus other assets that maybe it's taken 3 years. And lastly, I'm long gold and I'm short I know one of your speakers later on has a different opinion, but I'm short gold mining equities. There's no rationale for owning a gold mining equity. It is as close as you get to insanity. The risk premium goes up when the gold price goes up. You know, more precarious societies across the world are more envious of your gold assets at $3,000 than at $300. And there is no valuation argument that protects you against the risk of confiscation. And if you think about it, you were bullish on gold. Why didn't you just buy gold ETF, gold futures, or gold bullion? So what I want to be, and I'm going to shut up, my only point to you is that I have resigned from the professional undertaking of coin flipping. I'm not here to tell you where gold's going to be. I have no idea. That's my existentialism. I am a student of uncertainty. I have no idea where the stock market is going to be. So when I'm creating trades in my portfolio for my clients, I'm agnostic. I just want to enhance the probability that I make money come what may. And at that, I'll shut up. Thank you very much, ladies and gentlemen.
Good. Well, thank you very much, Hugh.